Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And believe it or not, it is December already. And for some income investors, they're already looking over the horizon at 2026, laying out their income strategy plan. So that's what I wanted to focus on today. Today, we're going to be talking about trading covered calls in 2026 and maybe 5 key things that a trader might want to keep an eye out for, as market conditions can certainly change. So it should be a really, really good, interesting discussion for today. Before we get to any of that, Logan, let me first of all say hello to everybody who's already chatting in out there on YouTube. Great to see all the familiar names as always. Hello there, John and Lawrence, Kevin, see ya. Jay Richardson, Eva, Mark, Josh, Becca, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions here in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts. But be aware that you're invited to join us in the live stream. This is a Monday webcast series, and we kick things off promptly at 2 Eastern time each Monday. So if you'd like to be here, you're certainly invited. We'd love to have you here in the audience. Now, I also want to let our live stream audience members know that my very good friend Mike Fairborn is going to be hanging out in the chats. He's going to be keeping an eye out for any questions that I can't get to just during the flow of the presentation. Thanks for having my back there, Mike. And Mike and I would also like to issue an invitation to everybody listening. You should be following your favorite presenters, your favorite Schwab presenters on social media. You can find Mike and me on X. So you can find Mike on X at Mike Fairborn CS. You can find me on X at Cameron May CS. You can also now follow me on LinkedIn. So you just go to linkedin.com/in and then throw on /Cameron May CS for my handle. That'll take you right to my profile. Give me a follow. If you reply to us on social media, we try to reply right back to you. Great place to interact with your favorite presenters in between the live streams when the camera's not on. But let's get into this discussion, preparing for 2026, those income strategies. What might an income investor be looking for? But bear in mind this important information. Certainly, investing and trading for income, as well as other market approaches, carries risk. So bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so here's what we're going to be covering today. This webcast is part of an ongoing series of videos. So we're going to take a look at our existing positions. We have 6 trades in place, example trades. So we're going to see how those are going. Then we're going to be talking about how an income trader might be planning for the management of their trades in 2026. And I'm going to talk through 5 key considerations as we're attempting to do that. And that's going to be framed within an example trade today. So we'll go through those 5 things. We'll plan and place a trade. And that'll wrap it up for us. But let's get into our current positions. Let's go see what's going on. So we have 6 positions here in our covered calls and short puts portfolio, starting with Apple. With Apple, we sold. This was last week's trade. Sold at 265 put on what we saw to be a possible bounce off of a support level. Sold those contracts for 277. Right now, they're only trading for around $1. So that trade's doing rather well. Let's go see what that looks like on the chart. So here's the chart of Apple. You can see right here is where we sold those puts, hoping the price would go up, making it less likely that those contracts would be assigned. Break-evens down there at 260, 223 on this position. And stock's going off in just the direction we might hope. We're shooting for that December 19th expiration above 265. So that seems to be doing just fine. So let's go have a look. At our next position, we have Broadcom. This is a covered call. Bought some shares at 361.10. Sold the 390 calls for 585. Uh-oh, those calls are now worth more than we sold them for. Let's go see the history of our Broadcom trade. With Broadcom, we purchased the shares right here at 361.10, sold some 380 October calls. Those expired worthless for a 283 profit. Now we've sold some 390 calls for 585. You combine those two premiums together, and we have a break even down here at 352.42 through this new expiration. So we set this expiration here to be done with the trade before this earnings announcement. So right now you can see the stock popped up above 390. We prefer to be below 390. And as of earlier today, we were above 390. We've slipped down below 389. Really, that's just about if the trader wants to hold on to their shares, get as much appreciation as possible, but hopefully see the contracts expire worthless. That's doing just about what we might have hoped. Now, one advantage that we have in paper money is that early assignment is not a thing in paper money. It certainly can be a thing in real money. So this trade, we might have already had to sell the shares. That's a possibility in a real account. They would have been sold for a profit. So, forced profit-taking scenario. But doesn't happen in paper money. We'll just let this one continue to work, see if we can get to that expiration just a little bit under the 390 strike, and then hold the trade through earnings. So that's doing fine. You can see both of those first two trades. Currently, some nice realized gains on some, unrealized gains on other portions of the position. With Bank of America, we bought shares for $50.58. They're now worth about $3 more than that. We've already sold some calls and made a profit. We've sold some new calls at the $54 level. Now, we sold those for 47 cents. They're worth about 77 cents right now. Here's what's going on with our Bank of America position. Bank of America, we bought our shares down here at 50.58. We made a profit on some October calls. We made some profit on some November calls. We've now entered into some December calls. And those are up there at 54. How high did we get? Got up to 53.94 here. We got up to 53.90 here. So we've been teasing right up there at our strike. If the contracts go in the money, if the contracts, as they move closer to expiration, that combination of variables can increase the likelihood of early assignment. But we're still some distance from expiration. I'm going to let this one continue to work. Break even is now way down here. We'll leave that one alone. With our Google position, we own 100 shares, sold the 315 calls. Those are worth a lot more than what we sold them for. That's because the stock has been doing so well, and it has been doing well since we took this trade way back. Way back here is where we bought our shares, and we just recently started selling calls on this position. So we sold some calls here with the plan to sell to exit the whole position if support broke down below this initial blue line. Well, we popped up above that. That looks like it may be a new support, previous resistance. Our new plan is we'll consider closing out of this position entirely if this blue line support breaks. But we're well above that. So we sold. The current position is we're in the 19th of December, 315 calls. The stock right now is at 316.50, slightly in the money, still some time to expiration. Even if it were assigned, we would sell the shares for $315 that we previously purchased for $199. That would be a large profit on the stock, in addition to the premium that we collected. So we're just going to let that one go. We'll see how that plays out. Microsoft, we've sold a long-term put. Let's go to the chart of that one. With this one, we sold a put for $23 all the way down here at 380. The stock is way up at here above 480. We're nearly $110 still out of the money on these puts. We broke down through a support level. That's maybe something a technical trader might want to keep an eye on, see if that old support becomes a new resistance. If price continues to persist down toward that put, we might consider it exiting. But for right now, the trade is just slightly underwater. Where are we at this moment? Let's see. We sold those for 23. They're worth about 25 and a half. I'm going to let that one continue to work. Now, finally, we have our NVIDIA covered call. Bought some shares at 183.71. Sold some calls at 195. The calls are doing okay. The shares are not doing quite as well. Overall, down a little bit on that NVIDIA position. Here's what that looks like. We bought the calls or bought the shares here, sold some shares for a 340 profit, or sold some calls for a 340 profit, or a call. So there's already a realized gain there. We're in another call position at 350. So combined at 690 that's been collected on those two short calls, which has lowered our break even overall down to 176.81. We're slightly above that. Now that assumes that we're at expiration. So that's why we're not exactly breaking even right now. But actually, if we go back to this position, between our current call and our shares, we're underwater about $246, but we bring in the $3 and change that we've already realized on a previous trade. This one's actually a profitable trade overall. So with each of these, I don't really see anything that I feel like we need to address just today. So we're going to leave those positions on as they're currently constructed. And let's go plan and place a new trade. But this one, we're starting to push out, looking out toward 2026. So I thought, let's talk about maybe 5 things that a trader might want to keep their eye on regarding planning for income strategies, including covered calls, as we roll over from one year to the next. So what might those be? Let's map those out. Let's come over here to our scratch pad and open this up. Here are 5 things the trader might want to keep their eye on. Now, this is not an exhaustive list. It's just an example list of what traders might have as a priority. Feel free to customize it, update it, change it entirely as a trader sees fit. But number one is we might want to keep an eye on market trends. They've been quite favorable for selling covered calls and short puts, but that can change. Might also keep an eye on options values. Premiums collected tend to rise and fall with market influences, so we'll keep an eye on those. And I'll show you for each one of these. I'm going to list them out, then we're going to go apply those. All right. Number 3 is going to be, maybe for some traders, they watch for sector strength. I saw somebody asking a question here. Mark says, utilities and healthcare are down hard today. Is this the end of speculation about a cyclic rotation to safety, at least for now? Is there more of an appetite for risk, Mark? That's a possibility. And if a trader comes to that conclusion, might that influence, let's say, which sectors they go pursue an income through? Well, that's going to be up to the trader, of course. But how might we take a look at that? That's the question that I want to address. Number 4, as we have on our trades, maybe the trader keeps an eye on earnings announcements. Those can continue to have an impactful role on trades and, yes, even on income strategies. And then finally, all of that accomplished, maybe signals directly from a stock chart, right? So these are 5 potential priorities for an income investor or trader as they're planning for this year ahead. So let's go see what's going on with number 1. What do you think? Nobody has perfect insight into how 2026 is going to play out, but put yourselves in the shoes of an income investor. Maybe they're looking back. It's November of 2026. We think we're going to be looking back on a time that's been positive for bulls and for income strategies built around that, or maybe does there need to be a shift? So I'd like to know just from you, of course, and of course, everybody's saying, oh, I'd like to know that too. What I mean is, I'd like to know my audience's thoughts on those. Well, here's what I see. Here's what a trader might be seeing as they're looking at the S&P 500 right now. Great run since April. Little bit of a struggle up here at recent highs. So kind of choppiness over the last 2 months or so. Lows possibly around the 65.50 level. Highs up there around 6,900. So kind of channeling. Now, when a stock or an index starts to channel when it's previously been bullish, is that typically seen as bullish or bearish? Well, an initial assumption among technicians is typically that when we see hesitation in the markets or in a stock like this, where we're channeling or going sideways between highs and lows, it's more likely just a resting point. It's like hitting the landing when we're going up a flight of stairs. We go up and we go sideways and then we start going up again. Is that a guarantee? Of course it's not. But let's say that our technical trader thinks that we're just on the landing here and we're going to start climbing again as we start to move toward 2026. Well, what might change their mind? For some, they might employ a technical technique or a technical indicator known as a moving average. Let's add a simple moving average to our chart. This is a trend line. It's automatically generated for a specified time frame. I'm going to say for 100 days. Let's click OK, click Apply, click OK again. So what we're seeing here is a trend line that's just looking at average closing values of the S&P 500 over the last 100 days. So that average value, as of right now, is 65.75. That's the average close over the last 100 days. And you can see the current S&P is well above that 100-day average. Now, for some traders, if this line is still going up, that's commonly seen as a continuation of bullishness, unless price closes or crosses down below that line. If price crosses below that, that might be a violation of a second potential use of these trend lines, and that is potential areas of support or resistance, price floors or price ceilings. So now this is just one thing. I think it's interesting that right now that's right about at these previous lows. But if the S&P were to fall and break down below that 100 for some, that may be a signal, hey, maybe 2026 is going to be like some of the rougher portions of 2025. Time will tell, but keeping an eye on those market trends. For right now, let's say that our trader's still bullish, right? So that might move them on to step number 2, which is looking to see, well, what is the market for options right now? How might we check on options values very broadly, or just look at the options market in general? Well, that might be done using a different chart with the symbol VIX. Now, I don't need the moving average here. Let's take this off. Some of those traditional technical approaches kind of break down on this chart because it has a sideways orientation over the long term versus indexes typically have an upward slope bias. Yeah, Mark, Eva, Pia Law says VIX. Yeah, so specifically, this is a chart of expected volatility over the next 30 days according to how options are priced. That sounds kind of complicated, but really it's just a gauge of how volatile traders think the S&P 500 is likely to be over the next 30 days. And when there are spikes in that expected volatility, options prices tend to go up. Demand from speculators tends to go up when there's more volatility expected. Demand from hedgers using options to hedge stock portfolios, that tends to go up when there's a spike in volatility. But yeah, when we see spikes like this, there tends to be an increase in demand and therefore an increase in prices. And for those searching for income, what this might mean is that when we see these spikes, the premiums collected from selling calls or selling puts might be higher than normal. And that's because we're doing it at a time when markets are volatile, right? So there are pros and cons to that. But if we look at where we are right now, volatility expectations have kind of been bleeding out of the markets. And we've been coming more toward 12-month lows. So the bottom take-home lesson here for the income investor, as they're looking at December, maybe as they're looking at selling out into January of 2026, is they might still feel okay with going and selling options, selling calls, selling puts, but the premiums are likely to be less than maybe they've recently become accustomed to. Right. So that's sort of the options value market, or what's going on with options. Let's see what's going on with sector strength, to go back to the question from the chatters. Which sectors are strong and which sectors are weak? Because I want to talk about both of those, because for some income investors, they prefer to pursue income in sectors that have already seen significant strength. For others, though, they're kind of contrarians. They're looking at areas of the marketplace where others aren't looking, and they're trying to find unexploited opportunities in that, through that sort of a lens. So what's been one of the sectors that have been particularly strong? And how might we find that? Well, over here in the watch list, Thinkorswim actually maintains and publishes a watch list of the 11 sectors that make up the S&P 500. And we can just go to watch list and click on that sector, on that watch list heading, and go through the public watch lists down to S&P 500 sector indices. Just think of it as sectors, okay? So here are those sectors, and some of you might be saying, well, one sector that's been really strong is information technology. Yep, It's been really strong. A little bit weaker, though, recently. That's kind of interesting. I wonder how this weakness has been relative to the weakness the S&P 500 has seen. Let's throw on one indicator here. I'm going to click on our little flask icon, and I'm going to add the relative strength. Is our sector relatively stronger or relatively weaker than the S&P 500? So I'm going to add relative strength compared to the S&P 500. Click Apply, click OK. And what we might see, let me remove these drawings. These are drawings that I made recently. That because this might be, might be interesting for a technician. For a while here, the lows have been climbing, establishing kind of a trend line on that relative strength indicator, but we've just broken that trend line. That may indicate that that technology is not holding up relative to the S&P 500 like it has through most of the year. Maybe some additional weakness kicking in here where it's not truly obvious on the price chart. So for some traders, my apologies anyway. So for some income-oriented investors, they recognize no sector just gets to stay in the limelight forever. Maybe some will sometime, not in my experience has anybody ever managed to accomplish that. So maybe they turn their attention to sectors that have been out of favor, and are they possibly moving into favor? And one of those sectors that's just showing maybe the slightest signs of life, a little bit stronger pulse, as an example, might be energy. Energy has actually been making higher highs since April, just not quite as sharply as the S&P 500. And really, there was kind of an extended sideways period right here. But you might notice energy making higher highs and higher lows more recently. And for a technician, they might see that as an acceleration of strength. So let's say that our income investor has looked at what's going on with the stock market. They've looked at what's going on with the options market, and they're looking for sector strength that's maybe not necessarily continuing, but potentially emerging. They might see something like energy as a possible opportunity. Nobody has a perfect insight. It's only a premise. We'll see. John says, are you willing to talk about callers, or is that a different session? I don't talk about callers in this webcast series, so thanks for asking. We absolutely do talk about callers, and I have, as a matter of fact. So if you have an interest in a specific strategy like that, or in any specific topic, you can actually do yourself a favor. If you haven't done this already, subscribe to our Trader Talks channel on YouTube. You can just go down and click on subscribe right now. It doesn't cost anything to do that. But our Trader Talks YouTube channel is where we house other webcast series. You can join the live streams here, or you can find the series archives under our playlists. Now, what I would suggest you do, if you do have a specific strategy interest, a specific indicator interest, something like that, go to the little search here and type in, for example, throw in that L, callers. Okay, hit enter on my keyboard. What's right here at the top? Trading callers, how to use options for protection on stock trades. So there you go. Becca says, where do you find the sector that has the number? I think so, Becca, what you're talking about is we have these sectors right here. These are the symbols, and they all have an assigned number, number 10, number 15, number 20. You can memorize those 11 if you want to. Or what I just did is I added description as one of the custom columns here. You can just click on the little gear, customize, and add description right there. Okay. But these numbers here, those are just by default in Thinkorswim's public watch lists under sector indices, S&P 500 sector indices. All right. So there we go. 1, 2, 3. Let's move on to number 4, which is keeping an eye out for earnings. Now, I kind of cheated here. I'm going to hit the back button in just a moment. Let's move on to our example stock, which I happen to know doesn't have earnings right around the corner because it just had earnings just in the rearview mirror. How did I know that? Let me clean up my chart just a little bit. I don't need relative strength for this portion of the discussion. But you'll notice I have extra space out here to the right. I also have these lines that represent options expiration. That's the third Friday contracts. And finally, I have these icons down at the bottom for earnings and, yes, also for dividends. Well, by default, you're not going to have all this stuff. So let me take it off and I can show you just how to put it on. So let me make some quick adjustments here. Here, click apply, click OK. So this is what a chart might look like, where the most recent candle is bumping right against the right margin, so no extra space. There are no lines indicating when those third Friday contracts are expiring, and there are no icons down at the bottom. So let's add those. We go up to our chart settings, because those are all found in the settings. And first of all, if we go to the time axis, we can check the box for show expiration Friday, because those happen at a specific time each month. And I can add some extra bars out here to the right. Let's add 20 bars to the right, extra space out beyond this last bar. Now, I'm going to go ahead and click apply so you can see those. There's the extra space, and there are those dashed lines. Now, finally, to get the indication of when earnings and dividends are paid, let's go to equities, because those both relate to a stock or an equity, and check the box for show corporate actions. So corporate actions are actions taken by corporations that can affect share value, like paying a dividend or announcing earnings. So let's click apply. That gives us those icons. And we're all set up with our chart to tick the box for number 4, which is keeping an eye out for earnings announcements. Because with an income strategy like a covered call, when a trader sells a call, it installs a cap, a conceptual cap on how much might be made on stock price going up, because we're agreeing someone else can buy our shares for a fixed price for the duration of that contract. So if the shares go above that price, that trader is not benefiting from that move, theoretically. So for some, they don't like to do covered calls. Not everybody, but for some traders, they don't like to do covered calls over earnings. And this is a quick way to keep an eye out for those sorts of announcements. So, for example, I can quickly visually see, well, if I were to sell a call, let's say one for December 19th, there's not an earnings announcement before that. What if we went out to January? Let's add a little more space. Let's go up to, actually, here's another way we can add more space off to the right. Click on the little double-headed arrows down here. Those are the right expansion settings. And let's change the right expansion settings. And let's go out to maybe 40 days. Click apply, click OK. And now we can see the January 16th third Friday contract expiration. And there's not an earnings announcement. So we can peek out over the horizon. We could also just do the math here. If we have the icon here, I can see last earnings announcement was on October 31st. So let's count it out. So October, November, December, January 31st or thereabout is likely where this next earnings announcement is going to be. All right, so that's really number 4, checking to see, is there an earnings, and deciding now that we know if there is or is not, are we still okay with maybe going ahead with this income strategy? Now, finally is number 5, chart. Let's see what's going on with this stock that we've chosen. So why did we choose this stock? Well, maybe the investor thinks it's in the right sector. You know, energy, for example, seems to be showing early signs of emerging strength. We'll see if that plays out. But XOM on its own has been making higher highs and higher lows. And a couple of observations beyond just the trend is that when entering into a strategy such as a covered call, that strategy can benefit in 2 possible ways. Number 1, price on the shares that we own can go up. Number 2, we might be able to collect income at a price above the current price in most scenarios. Not everybody sells out of the money calls, but income and capital appreciation are sort of the dual potential values of a covered call. So the chart may help the trader decide which of those values to pursue now, maybe both at the same time. But typically, if we want the stock to go up, does the trader buy the stock when the stock already appears to be at highs, or when it appears to be closer to lows? Yeah. Buying the stock might be done either as we sit at an apparent price floor and we're rising up from it, or if we've broken through a previous price ceiling. So in this case, looks like the stock is starting to run upward. So for some traders, even if they're income investors, that might tilt the scales for them to make them think that maybe price appreciation is a possibility here. Now, on the other hand, what about where might we sell the call if the objective is to let the stock appreciate as much as it can, but not get called out? Well, in that case, we buy the stock at support and maybe sell the call at or above resistance. We look for a price ceiling for positioning the call. So in this case, it looks like recent ceilings look like they're just below 120. I'm going to draw a line up there at 120. And let's carry that out. Yeah, let's go out there and look at, maybe let's do a trade for January, since that's sort of the premise of this discussion. Let's push out into 2026. So here the trader might think, well, the stock might go up, bump its head against that resistance and come down by that January expiration. So we get the appreciation in the stock value, but hopefully the contract just expires worthless. So for that might be number 5, looking at our chart signals, buying the stock at support as an example, selling the call at or above resistance. All right, so let's go ahead with this trade. Mark says second consecutive ExxonMobil earnings surprise. XOM claims it's doing share buybacks to improve EPS. Some analysts have a target of 145. Okay, we'll see if that proves to be accurate. And of course, one earnings event, while positive, isn't always a guarantee the next one will be. But in this case, let's trade this as though the trader thinks the next earnings is going to be positive. So we're not going to have a covered call in place at the time of the earnings, but that earnings should happen after January 16th. Okay, RB Tech Trader says, what about selling a put for income, assuming the stock is expected to go up? That's another great question. And actually, each of these can be applied in pretty much equal measure to that approach. Yep, because a covered call and a short put, when done on the same stock at the same strike, are nearly identical strategies. So good question. Let's go ahead with this trade. I'm going to buy 100 shares. That would be about $11,000 trade. And let's see what we can get for a 120 call. Let's go to the trade tab. Look out to January, out to 2026. There's the 16th of January. The 120 calls are trading at 220 to 226. The next available strike is 125. Those contracts are around 85, 90 cents. So let's go for this 120. I'm just going to right click on that 120, and I'm going to put in a buy order for what Thinkorswim calls a covered stock. That's covered call, right? So we just need to tailor this. We don't want 10 contracts for this example. I'm just going to do one contract on 100 shares, 16th of January, 120 calls. Looks like the net cost of this trade, the net debit, after paying around 118 for the stock and collecting around 2.5 for the call, brings that net debit maybe down to around 114. Let's say we're willing to spend a little bit more than that. Let's say 160 or 114.65. Just in an effort to try to improve the likelihood of a quick fill here. We'll put that in as our limit. Let's click confirm and send. Buying one XOM covered call, selling the 16th of January 120 call. The maximum debit that we're trying to spend here to get into this position is 114.65. There is a commission to be paid on that short call that we're selling, so that increases the net debit to the maximum that we're willing to spend to $11,465 and 65 cents. Let's send that off and see if we can get a quick fill. Yep, filled. 114.61. All right. Well, guys, we've actually accomplished what I set out to do today. 2026 is right around the corner. So I wanted to talk through an example set of priorities that a trader might have for their income strategies as they're planning for this next year. What's going on with the stock market? What's going on with the options market? What's happening with the sectors? Which are stronger? Which are weaker? Are there change in those statuses? Where are the earnings announcements on the stock that I'm considering trading? And finally, what does the chart have to say regarding the timing of buying the shares and selling the calls, regarding the positioning of buying the shares and where do we sell those calls? So hopefully that was a nice, helpful discussion for you. Obviously, some of you may have noticed, Cameron, you didn't mention this or that might be included in this list of priorities. Every trader has their own list. This is just an example, but I do hope that it was helpful for you. I'm going to turn you loose to go enjoy the rest of our webcast for the rest of the week or the rest of the day. But as I do have some suggestions for you so you're fully aware of the full range of educational resources that Schwab Coaching has for you. Number one is if you haven't subscribed to our Trader Talks channel on YouTube yet, do that. All right, here's our channel, Trader Talks Schwab Coaching Webcast. There's my live stream right there. So you can join the live stream, but you can also find the playlists of previous webcasts. So for example, if you want to play a little catch up on this webcast, if you didn't see the logic of the Apple and Broadcom and Google and other trades that we took in this series earlier, just go to our playlist, go down. It's in the second to right hand column, trading covered calls and short puts. You can find the full playlist right there. And as I click on that, you can see here was last week's discussion. There's the week before. You can see the logic and the timing of previous trades. Now, another suggestion that I have for you is that you follow your favorite Schwab presenters on social media. You can follow Mike at Mike Fairborn CS. You can follow me on X. Now, when I say you can follow Mike, I mean on X, at Mike Fairborn CS. You can follow me on X at Cameron May CS. So there's my profile on X. And if you reply to one of my posts here, I threw out this reminder last week, have a great holiday weekend. You had a short day on Friday. But if you reply to one of these, I just try to reply right back to you. It allows for nice interaction. It's not otherwise available when the camera's off. Now, as of about a month ago, you can also follow me on LinkedIn. Pretty small crowd of people following me on LinkedIn right now. I just newly started this. So I'm posting here on LinkedIn. If you reply to one of my posts, I try to reply right back to you as well there. So certainly give me a follow there. Give me a follow on both. Just a great place to connect with your favorite presenters. Anyway, that'll do it. Mike, thanks for helping out in the chats. I didn't happen to catch there a survey, but if there is a survey for the live attendees, it's always appreciated to fill those out. Thanks to everybody who's already clicked the thumbs up. 129 people watching the live stream right now. 42 have already clicked that thumbs up or that like button. That always helps when you do that. It's a nice pat on the back to your presenter, but it also tells YouTube, hey, this is a good video. Let other people know about this video. It helps us get a larger promotion from YouTube and more people to find. It allows more people to find these discussions, like what kind of a checklist might they have as they're planning their income strategies for 2026. All right, everybody, thanks for giving me your time. I will see you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.